Special application areas, we are done with it. So the next one is what we call contingent liabilities. Okay, contingent liability. Contingent liability is not recognized. Simple. It's not what? It's not recognized. But only what? Only disclosed in the financials. So that is what it means here. Now let us look at the what? The probability. Now the contingent liability. What is it all about? So if the company expects that they have liability to incur, or they have liability that should appear in their what? In their books. You see, I would say contingent. So what forms or what qualifies a liability items? And you know that we have current liability and non-current liability. So how do we recognize current or non-current liabilities in our books? So that is where now we have what we call contingent liability. So if we have contingent liability, can we recognize any liability which is contingent? And the standard says no, but you can only disclose it in your what? In your book. So assuming like maybe there's an expected liability that the company is what will be paying. You are not sure whether the liability will suffice for the company to bear that cost or not. You don't know. So it is treated as what? Contingent liability. And the standard says that when such situation occurs, don't treat it as a liability, whether current or non-current. Don't go and treat it there, because we are not even certain that this liability or what will come to us in our books. So what do? You should disclose it. And the standard is saying that check this probability. The probability that you are certain, if you are certain, which is more than 95% certain that more than 95% certain that it will happen, it will come to you as a liability, then recognize it. Recognize as what? As a liability in your books. You understand? Recognize this as liability. So if maybe you agreed with what? With a supplier to supply you with a goods. You've not received the goods yet because you are going to take it on credit. So you've not received the goods yet. So once you've not received the goods yet, how could you go and then record it in your books as for liability? But they want to say that now, if you are virtually certain that it will come to you, you are more than what? 95% certain that it will form part of your what? Of your liability, then you need to treat it as a liability in your what? In your certain financial position. So once the goods are in transit, you are yet to receive it, but you are certain that the goods is close by to your what? To your factory, then clearly you will surely receive it and check the specification and everything. Then if you are sure of that, then you treat it as liability, because once they supply the goods to you, it is a form of purchases, but it's on credit. So with that one, treat it as what? As a liability in your books. You understand? Other than that, you disclose it what? In the books. Now, if it is probable, so if it is probable, meaning if it is greater than 50%, they say treat it as what? Recognize it as provision. Recognize it as what? As provision. It means you will put it until what? It matured, or it matures to qualify as what? As a liability. So it will be on what? It will be seen as what? As a provision. If now it is up to 95% certain, then you can actually recognize it as what? A liability. So it will be possible. If it is possible, then that means not probable, which is what? Less than what? 50%. Then you should what? You should disclose it. If it's less than 50%, disclose it as what? Contingent liability. That's what. Then the last one is what? Is remote, right? If it is what? Less than 5%, that one too, how do you? Don't disclose at all. Less than 5%, don't disclose at all. Clearly, there's no tangible information, no disclosure. Right. So that is contingent liability. Now let us look at contingent assets. Okay, contingent assets, they are never recognized. It is only what disclosed when an inflow is what is probable. Right. Okay. And they say that when realization is virtually what certain, the asset is no longer contingent asset and is what recognized. Okay, so let me give you example. Example of this one is this. Company A is expected to receive cash from customer and is certain of receiving it, then it is not a contingent asset. You see, so this is a typical example of that. So if you have what you have expected money to receive from what from your client, because once you have money with them, they become your debtors, right? The expectation that you will receive the money, if you are not certain, then you don't recognize it or as a provision. So they will be sitting in your books as what? As your debt, right? But if you are certain that you receive this money, then what? It is what? It is actual what? The actual is then you recognize it. So let us look at this example. Danqua Limited is suing a supplier for breach of contract. Legal counsel advises an 80% probability of winning 400,000. He has advised that you are what? You are going to 80% probability of what? Winning 400,000. What are you going to do? How are you going to what? Recognize this one? So you have what? Danqua Limited. All right. Okay. The suit is how much? 400,000. Lawyer advice of recovery is what? 80% what? Chances. So how are you going to recognize provision under IAS 37 contingent asset? Because this is what receivable. You understand? This is your receivables. So your receivable is what? Is an asset. You understand? So you seal it for your money. So it's on your asset. Now, lawyer has advised you the 80% chances of getting the money, right? So what is the standard say? The standard says that they are never recommended, only disclose when an inflow is what is probable. Only when an inflow is what probable. When realization is virtually certain, the asset is no longer contingent asset and is recognized. And you already know, watch it here. Virtual, certain, probable, and possible, and remote. All of them are here. So the same also applies there. You see the whole thing. So the question says that the chances is what? Is 80%. And we know that virtual certain is what? Is 95% or what? Or more. And they're giving you probable is what? Is 50% or more. Possible is not probable. So possible is what? 50% or what? Or less. So here, so this is the metric that they use. So they've told you that the possibility of what? With recovering the money is what? Is 80% chances. You see, it's 80% chances. So how do you go about it? If it is 80% chances, what do you do? It means it is not up to what? Virtually certain. So it's forced to be under what? Between what? Certain and then probability. So probable. So if it is probable, what did they say? It is said that if it is probable, what? Do what? Recognize or disclose, right? That's what they said. So if it is 80% chance of what? Of recovery, then it is what? It is probable. Therefore, do not recognize. Do not recognize. But what? But disclose. Simple. All right. So that is it about this question. Okay, finally, let us look at reimbursement. Okay, now under reimbursement talks about when some or maybe the expenditure required to settle a provision, right? So when some or all the what all the expenditure required to settle the provision will be reimbursed by a third party. By a third party. So this is simple. The reimbursement is what is recognized as a separate item. That's all. Okay, so what this means is that when it is what? It is virtually certain of what? Of receiving the money. Okay, what this means is this. You are a company, you've created a provision in your book. Like maybe you have 40 million sitting in your book. And the company decided that they will ensure that's they've entered into what? Into insurance agreement with what? With a third party. All their provisions when they when they incur them, the third party should pay all the provision that they are going to incur. That's what you call reimbursement. You understand? That's what you call reimbursement. So if the company decided to what? Insure all its provisions, we call it what? Reimbursement. Example, has a warrant 1 year. 1 year to customers. Provision. There are provisions of maybe 600,000 cedis. They have insurance of maybe 400,000 cedis. How is the reimbursement treated? Okay, so you have it here. It is simple. You do your extract. You have provisions 600,000, but insurance is going to reimburse 400,000 out of the 600. So how do you treat this one? So you come here, solution, profit and loss extracts. You realize that you have a provision balance of how much. You already have provision of 600,000, and the insurance can only pay 400,000 out of the 600 for you. So you have provision of 200,000 total. You understand? Okay. Then you go to your statement of what? Financial position. Statement of financial position. Okay. In your statement of financial position, when you are certain, you understand, when you are certain, that's virtually certain that you will be reimbursed, you will have it under current asset. We call it what? Reimburse. So when you are certain that the money will come, you will treat it here 400,000. And then your non-current liability will contain the provisions of what? Of 600,000. This is how your P&L and your books will look, right? You are certain that the third party will pay 400,000 out of 600,000. Then you'll treat the provision like this. You will less assurance of 400,000 from the provision. So you have 200,000 as your provision. Then when you come to your statement of financial position, you have because you are certain that the money will come, you will treat it under current asset as reimburse 400,000. Then the actual provisions will come as 600,000. So that is how reimbursement is what is treated. So let us look at this small question. Ajma Limited has the following at 31st December 2023. A lawsuit where legal counsel says 65% probability of paying 300,000 damages. B, an environmental obligation to clean up contaminated land in 3 years, costing 1.5 5. Contaminated land in 3 years. An environmental obligation to clean up contaminated land costing 1.5 at a discount of 5%. Contract to buy inventory for 800,000 where market price has fallen to 600,000 and cancellation penalty is 150,000 for each. State treatment and prepare any necessary journal. You see, so this is what a jacket of 3 that they've given it to you here. All right, so once you've had it, let me switch and let's see how. So the company name is what? Ajman Limited. All right, so let's look at the A. A is what? Lawsuit. Okay, so lawsuit. So they said the damage is how much? The damage is 300,000, and then they also said that probability of paying is what? Is 65%, right? That again. So you can clearly see that the first one is what falls under legal obligation. So here, one, you need to first know solution. So one, you need to know if there's any present obligation. There's a present obligation. There's a present obligation. That's why you are sued. So since there's a legal obligation in this suit. 2, you should find the what? Probable cash flow, which should be more than 50%. And in this case, they say it's what? 65%. And then 3, the estimated cost, right? Probable what? Measurement. Okay, so the 3 is what? Reliable estimate. So the reliable estimate. So what the reliable estimate? That what can be measured. I say what is 300,000. So this one is what is qualified for provisions. You understand? So all that you have to do is that you need to well, that's what the question wanted you to. You understand? So that means it has crossed the line. So here provision must be created. So A, let's say it meets all the conditions. Therefore, provision must be recognized. So you do your journal entry. So your journal entry, what do you have? You have your what? You have your debit and you have your credit. Provision, expense, or P&L, 200,000, and then you have your provision in a statement of financial position. That's all. So let's go to B. B, what did they say? They said that environmental obligation to clean up contaminated land in 3 years or 3 years time. This is discounting. So this is discounting. So they're giving you that clean up 3 years time. They're giving you cost is what? 500,000, and then cost of what? Capital is 5%. So what do you do here? You first find the discount factor, which is what? 1 plus 0.05 to the power of 3 years. What do you have? You have what? 0.86. So now that you have it here, it is simple. So you will have your provision to what? To be 1 times what? 0.864. In 3 years, and it's going to cost you 1, 2, 9, 5, 7, 5, 6. All right. So since you have it like this and it is discounted, then you calculate your unwound discount for year 1. So that gives you 1, 2, 9, 5, 7, 5, 6 times the interest rate of what? 5% for year 1. That gives you what? 6, 4, 7, 8, 8 dollars. So you have 2 items there. You have one, the provisions, and you also have what? On one discount or what? Or finance cost. So 2 things. Whether you do extract or you do what? You do journal entry. But in this question, they said that we should do journal entry if you can if you've seen it, they say you should what? You should do what? Journal entry to all of them. So what you do here is what you do. So you do your, so when we pick the unwound discount first, so you have what? We have our journal entry here. We have our debit and credit. So one, so debit what? Provision. So bracket the unwound discount, right? Which is how much? 64788. Then we credit what for your finance cost, which is what? 64788, like this. So this is how you do your journal entry. So if you want to also, so when you are done with the unwound, you will come and do your provisions. So you will have your provisions, which will go towards your P and L as how much? That one is what? 129,295,767. What? 129,5,767. So this is what your statement financial position. All right. So we are done with what? Point 3. So let's look at the last one. The last one is what? Contract to buy inventory according to the cancellation. Okay, so we have it here. So the C is what? Onerous provision. Okay, so with this one, they have what? Contract to what? To buy inventory. Inventory of 800,000. 800,000. Now the market price is now 600,000. Okay, so the market price is now 600,000. And they're giving you what? Penalty. 150,000 is onerous provision. So the inventory price value has now reduced to what? To 600,000. So how do you do it? So this is onerous. How do you find out what your onerous contract? You have what? The initial inventory to what? To 800,000. Market price, current market price is now what? 600,000. So it will lead to what? A loss of what? 200,000 for the company. So this is what you call cost to fulfill. Now, our cost to fulfill to be 200,000. Then you have what? Penalty of what? Of 150,000. So between the two, which one is of lowest? Which one is lower? Because you are given a contract to buy inventory of what? Of 800,000 for sale. So the market price has dropped to 600,000. It's a loss to you because when you sell it, you are going to get 600,000. So now this is the what? This is the loss of expected loss of the contract. When you abandon the contract also, you are going to what? You are going to incur 150. So in between, which one will you opt for? Will you continue with the contract, or you abandon the contract and incur a loss of what? 150? Then if so, the standard says that what? Choose the lowest of the cost. So here you pick the penalty. So if you pick the penalty is the lowest, then you have to draft your journal entry for it. That's all. So you will have your debit, and you have your credit here. So here you have your onerous expenses, which will go to P&L, which is what? 150,000. Then you have your onerous provision, which will go to what? Statement of financial position, as this. So that is it about that. Any question?